You're watching the Daily Market Comment by Mario Hadjikyriacos for Wednesday, September 14th. I'm Christina Marujos. Thank you for joining us at XM.com. Hopes that the Federal Reserve is about to ease off the brakes got crushed yesterday under the boot of another shockingly hot U.S. inflation report, sending shockwaves across global markets. Consumer prices defied forecasts for a monthly decline and instead rose in August, keeping the yearly rate running at an elevated 8.3%, despite the continued decline in gasoline prices. Most importantly, the core rate that strips out volatile items like energy and food rose sharply. With underlying inflation going in the wrong direction and the labor market still near full employment, market participants concluded the Fed will have to roll out even bigger guns to cool the economy. Moreover, investors also raised the profile for the terminal federal funds rate, which is now expected to peak at 4.3% in the first quarter of next year. Wall Street suffered some heavy damage, with the S&P 500 losing a stunning 4.3% as technology stocks were decimated. Tech shares and unprofitable names are especially sensitive to changes in interest rates, since their valuations are based mostly on expectations of future growth. Beyond the valuation angle, though, there is also a sense that the harder the Fed raises rates, the higher the risk of a recession that chips away at earnings. The undisputed winner was the US dollar, which enjoyed a double boost from rate differentials widening in its favor and safe haven flows. Hiding in the reserve currency has been the only winning trade this year, and this dynamic is unlikely to change as long as the Fed keeps beating other central banks to the punch and the prospects for the global economy are deteriorating. Over in Japan, the authorities have dialed up their rhetoric on FX intervention. The government escalated its warnings by characterizing the moves in the yen as reflecting speculation and not fundamentals, while the Bank of Japan called dealers at major banks to check yen prices, a practice that has preceded currency intervention in the past. This is essentially an ultimatum, with Japanese authorities trying to flush speculators out of short yen bets without getting their hands dirty. While the jawboning was enough to stop the bleeding in the yen for now, the virtues of actual intervention to prop up the currency are questionable, as it would be extremely costly, unlikely to succeed without global assistance, and could even backfire. Thank you for watching the Daily Market Comment here at XM.com.